All righty. Screen sharing. All right, Devin, you can still see my screen.
Yep, good to go.
Okay, perfect. All right, we'll get this thing kicked off. We still have some folks coming in, but in the meantime, thank you for everyone who's joining us today. My name is Ryan Staton. I'm a managing partner at StatonWalsh. I'm joined by my partner, Devin. Today, we're going to have a guest speaker, Evan Roberts, who's a partner at Chesapeake Brokerage. Chesapeake Brokerage is here local to the Mid-Atlantic region. They are a life insurance, disability, and long-term care brokerage. The topic of conversation today is long-term care. Evan has over a decade of experience in the insurance world. He's very well versed in the area of long-term care. We thought it'd be valuable to get his perspective, hear a little bit more about long-term care planning, as well as some insights on the industry in the area of things like long-term care insurance. So with that, today's presentation, we're going to just share a little bit more information about what long-term care is, and then also go through some examples and some action items that you can take back and keep in the back of your mind for potential implementation, as you navigate through retirement, into retirement, and through retirement around this specific topic of long-term care. So with that, Evan, I'll turn it over to you. Thanks for being with us today.
Thank you guys for having me. Thanks for allowing me to partner with you on this call, and thank you to everybody who's taken time out of their busy days. We're going to be giving, like Ryan said, what we feel is a overview of the importance of proper long-term care planning today. What I enjoyed most about partnering with you guys in this financial planning world is your approach to clients, how client-centric and education first you are to planning in general and in multifaceted approach. Long-term care is something that I feel, and I know you guys feel as well, is something that needs to be discussed very early on from a family dynamic, a product dynamic, and a financial planning dynamic. It's ever changing, and it's something that people are very interested in hearing about, but there's a lot of different ways to plan for it. So we're hoping today gives you an idea of how we approach it and just an overview of actually what long-term care is. The topic in general has gotten a lot of light shed on it recently. I know that we have all talked a lot about it. We've had clients bring it up to us and ask what it's all about. And so it's very timely to have a webinar and a discussion around what type of planning options are out there. It's not just timely because people want to hear about it. It's also timely because what's going on in DC right now, and also in the state of Washington. So a little tidbit here before we start is Washington State actually just passed the first of its kind act called the Washington CARES Act, which essentially is a government-funded long-term care program. And so with that taking hold, we don't really know how the federal government or the state regulators are going to try and regulate the private long-term care marketplace in the future. It's something to keep in mind, and it's even more reason to have conversations today about what proper long-term care planning is. So I'm going to start with a quote, Ryan, if you don't mind going to that page, from a gentleman named Harley Gordon. Harley's a guy I've met a few times and seen speak on multiple occasions. He's been in the long-term care world in almost every facet. And I think this quote really sums up how we approach proper long-term care planning and the fact that it is more than just a monetary concern of most individuals. So the quote is, "There's perhaps no other unexpected serious event in life that has the potential of causing serious, if not irreversible consequences to a family than a need for care over an extended period of years." A lot of advisors in my experience talk long-term care in a single facet approach. Is there a product out there that can solve this need, or is there, have I had the conversation to check the box? Their client may know how much it costs, and as long as their client has money maybe set aside or knows what it costs, then it's fine. You guys and I know that this quote means a lot and delivers a lot of ideas to start the conversation around long-term care planning, which is not just a one-time or one-size-fits-all approach. So we'll go to the next slide and talk about the actual definition of long-term care. So the National Institute of Aging defines long-term care as Long-term care involves a variety of services designed to meet a person's health or personal care needs during a short or long period of time. These services help people live as independently and safely as possible when they can no longer perform everyday activities on their own. So one word sticks out to me here, and it's independence. So with a properly executed plan for long-term care, people can make decisions adequately because they've made a plan prior to an event like this happening. When you don't plan, that's when this independence goes out the door. Your family and your bank account have to make these decisions for you sometimes. So again, it's not just a monetary concern of most people. A lot of people, involve their family from the get-go and should involve their family from the get-go in these conversations if they're going to be involved in making decisions for them. Talking with advisors such as yourself and hopefully creating a plan and solution will alleviate some of the stress and provide that independence to your clients and the consumers talking about long-term care. You hear all the time, my spouse and kids are going to take care of me. I have enough money. The real question is, do you have a plan, and have you actually discussed this with your family? So today we're going to talk about how not properly planning can become more than what you may think. So we'll start out with some statistics here. These are just from studies that have been done in amongst the insurance industry. You can see all the sources here, but they're pretty eye-opening to start this conversation. And they're pretty staggering, which is why I feel it's so important, because we do hear that objection on a regular basis. I have the money if I need it for long-term care, or it's not going to happen to me, good family genes or whatever it may be. There's a million objections. So 70%, someone turning the age 65 today has almost a 70% chance of needing some sort of long-term care service and support in their remaining years. 1/3 of today's 65-year-olds may never need long-term care, but 20% of those are going to need it for longer than 5 years. And then 3 years is this magic average of someone needing some form of long-term care, whether it is in their personal home or in a facility. So there are ways to address these statistics with the proper planning so that you're not just another number and that you've planned accurately and you can alleviate some stress and burdens from yourself financially and from your family. So we'll talk now about the importance of this adequate planning and how do you address these concerns. We know that as we age, one of three things can happen to our assets. We're going to outlive them if we haven't planned properly. Our assets ideally are going to outlive us if we have some legacy needs or desires, or we can precisely time our spending with that passing. So in order to protect your assets, with a growing concern of an extended healthcare scenario in mind, we need to address what potential solutions are and start having a conversation around planning for long-term care so that you can precisely time that spending and your assets to live your life during retirement in your golden years as you had initially planned, and not put extra stress and burden on yourself and your family and your loved ones around you. You can go to the next slide, please. So there is a question I like to start off long-term care conversations with after that quote to really get people in the right frame of mind, which is, which of my financial commitments during retirement is discretionary? So the answer is going to likely be none. You've worked very hard during your life, more than likely, to get to where you are. You used a financial advisor, you worked hard, you put money away, and you finally get to the age of retirement where you say, okay, enough is enough. I'm going to step aside. I'm going to enjoy, the rest of my life doing the things that I love. That being said, if you don't put in place a proper plan, you may be forced to ask yourself this question and figure out where you're going to pull money and assets from if an extended long-term care scenario may happen to you. And so we'll talk a little bit about throughout this presentation, not only the financial impact, but the personal and emotional impact, the physical impact, and actually the timing impact. So, if you don't put in place a plan, one thing rings true. We know that providing care is likely not shared between siblings or spouses. And if you don't have a plan or a conversation in place, that can really lead to family turmoil in a tumultuous time during your own life. We know that it's not just going to impact your portfolio, but it could actually really be devastating to a family dynamic And so again, having the conversation early on is key and critical. I think that people push the conversation because they don't think that it is going to happen to them. And the best way to show that it could really happen to anybody and how devastating it could be in every aspect of your life is to actually look at this through case studies or situations that we have had or heard. So a lot of people out there, listening today have probably experienced loved ones or family members needing healthcare in the later years of their life. And so this may ring true to you, and again, address the importance of taking care of putting in place a plan for yourself and your family. So this case study, we just used, take names aside. Joe Smith lives in Baltimore, Maryland with his wife and 4 children. His mom lived in Rochester, New York, about a 6-hour drive, and was struggling with health issues in her mid-80s, right? Joe, being the closest relative, was forced to commute back and forth to make sure that his mom was getting the proper care that she needed and she was getting to doctor's appointments. And with little resources, his mom was forced to take out a reverse mortgage to fund her long-term care. Eventually, she was moved down to Baltimore to reduce Joe's monthly commutes. But during this process, Joe had taken time away from his family, his job. He had committed to travel over 6 hours, several times a month back and forth, because obviously he wanted to take care of his mom and make sure that she was getting the right type of care so that she could live her life comfortably. Now, being as she initially had to do a reverse mortgage as the care got too expensive and she hadn't planned adequately, he was actually forced to take some money from his own retirement savings and other assets to help fund this shortfall that they were experiencing in his mother's care until, unfortunately, her last day. So, first things first, let's actually talk about what the financial impact is, because that is key and critical to everything. The average cost of a nursing home for 1 year with round-the-clock care in Rochester is about $160,000. The average cost of a nursing home for a 1-year terminal illness facility in Bel Air, Maryland, which is where she was, is $131,000 roughly. So you take a guy doing well financially, he's taking care of his family, he's got young kids in college, they have things that they like doing, he has things that he likes doing, they have busy social lives, he's planning for retirement, working hard. With his lifestyle, he wanted to have about $100,000 a year saved for retirement to continue addressing the commitments he had to his family and to himself, right? Again, hopefully your family is going to step up when they need to, if that's what you feel is necessary. But financially, is your family going to be able to take care of you? And how is that going to impact what they are trying to do for their own family at this point in time? So knowing that he wanted $100,000 a year in retirement, with the spending that he had to cover for his mom's shortfall, he was actually looking at having 3 less years of savings for retirement so that he could help his family in a tumultuous time. The other impacts that we're going to discuss here are, 4 days a month for 2 to 3 years of him commuting up to New York. That's 96 plus days a year away from his family, his other commitments, his work, his job, taking people to and from, sporting events, going and visiting other things and doing what he liked to do on his own time. Again, you would hope that your family steps up, but it is physically draining to have to be in the car that long and go and see someone who you love dearly in that state. So there's a lot of impacts, when you're away from your family that could cause rifts. He was the closest person to his mom, but he had 3 other siblings who weren't really stepping up because they lived so far away. That can cause some stress and rifts in a family dynamic. So there's a lot of stress, for a 4-year period of time. You think about how stressful that is and what that does not only to the person receiving care, but actually their entire family. And that's a tough pill to swallow. And again, it reminds us that it's so necessary to have these conversations today so that you can start this plan and not unload and unleash this stress upon your family when you're already going through a very stressful time yourself. You can go to the next slide here. We'll talk about the emotional impact. So I talked about Joe's emotional impact. He had to see his mom, who physically wasn't able to really, act for herself, mentally wasn't able to make decisions. That's tough on him and his own family. However, obviously, it's very hard on the person receiving care as well. Her son had to make incredibly difficult lifestyle decisions for her. And you think about the definition of long-term care from the beginning slides, this lady unfortunately lost her ability to be independent. She thought of herself as a burden to her family. She didn't know how much it cost, but she knew that she didn't have the money to pay for these types of things, so it had to be coming from somewhere. She had no ability to decide where and how care was received. And I'll stop right there for a second. By implementing a plan, or I guess I should say by not implementing a plan, you may not have options to receive care where and when and how you want it. So you think about the Washington CARES Act that just passed, which is a government regulated, state regulated fund to provide long-term care. If you don't do the necessary planning today, you may not have very many options to receive care in your home, to receive care from a certain nursing home or assisted living care facility, to receive round-the-clock care if you need that at your in your last years when you need help. So you think about not having independence and not having the ability to decide where and how you receive care should immediately instill the importance of having these conversations and figuring out what your plan is going to look like. So this unfortunate circumstance made her completely draw her assets down to nothing, and she really depended on others around her during her last years of her life. Again, you would hope that people would do that, but if you have a plan, it will lessen the impact and the stress around you by relying on these other people. Next slide, please. Key takeaway here, everybody, you have to create a plan. It's not a product-based plan. It's not a financial investment type plan. It is have a conversation and create a plan that works best for you. The story brings up questions that need to be included in a gathering with a family, with friends, when you're having these conversations about what is going to happen when this ultimately might happen to me. Who is going to provide care should you need it? And where do you actually want to receive care? And I'm not talking about what facility do you want to receive care. A lot of people feel like they will be more comfortable, live a more comfortable life if they are able to receive care at your house. Let's make sure that you can get to a position where you're able to receive care in your house if that's what you want. If you want your family to not have to worry about providing care and you want to be able to immediately hire somebody to take care of you or to help out with activities of your daily living if you need that, then let's put in place a plan today and have this conversation. You know, it's kind of eye-opening, and I think statistics do a really good job of painting this picture. I know for myself, I would do anything to help my family. I know you guys would as well. However, when you think about, your parents, grandparents being in a situation where they actually need that type of help, you might be a little iffy of providing that care. You don't want to see your family members in that type of a situation. So there was a study done by one of our care providers a couple of years ago that these statistics really ring true to that statement. 61% of sons and 51% of daughters surveyed hope they didn't become their parents' caregivers. I don't think that is malicious. I think that is actually they don't want to see their parents in that type of scenario, or they physically can't do it, right? Maybe they live across the country. Maybe they live across the globe. Maybe they're financially not able to actually provide that type of care or stay away from their own families, so they can't. 68% of Americans surveyed agree that their children should not feel burdened by having to provide care. Well, if you don't put in place a plan in some form or fashion, you may not have any other choice. You may lose the ability to make those independent decisions. 63% surveyed consumers believe LTC helps allow people stay in their home longer. So to that immediate point of where do you want to receive care, if you have a plan in place and you implement that plan earlier than later, you can decide where you want to receive that care. And I think at that point in time where you need the care, whether whoever it's from, wherever you're receiving it from, whoever you're getting it from, being able to live comfortably during those years could extend that life expectancy, could relieve stress, which is obviously very negative in this type of situation for your own health if you're going through that. And so the key takeaway here, have the conversation and start putting a plan in motion. And it's not just a conversation or a product, it's truly a plan, and it's a strategy to create and fulfill that plan so that you have peace of mind throughout those golden years of retirement. Ryan, you can go to that next slide. And let's talk about what it actually costs here today. So in-home care These are all average cost of care in Maryland. Homemaker services, $4,500 a month. Home health aid, $4,700 a month. Community and or assisted living. We've got adult day healthcare is $1,800 a month, and being in an assisted living facility is $5,000 a month. Then you go to a nursing home facility, obviously, which would have around-the-clock care for somebody who's in worse off shape. A semi and private room are going to be over $10,000 a month. The money is real, and that's why and one more reason why it's important to put that plan in place today so that you're not financially burdening yourself, your plans for a successful and fun retirement, or your families as well. You can go to the next slide. So what is it? It's having a plan. Long-term care is not a product. It's not an investment. It's having an actual plan and a strategy with which you can remain safe in your own tight-knit community while protecting the emotional, physical, and financial well-being of the ones that you care and love for. You can go to the next slide, please. So there's different ways to approach this, obviously, now that we've gone through setting the stage. You can self-insure, or you can have a product-based solution. Self-insure, real quick, is simply pay as you go. Whether you've put in place a plan that you're going to set aside a certain asset or investment, you're going to use those dollars when you need to. Traditional long-term care is a type of long-term care policy from an insurance company that has low-level premiums. Think of it as a term insurance policy or a auto insurance policy that if you never die or you never total your car, you've paid for that protection over your entire life. You hope you never need to use it, but it's there if you do. Asset-based and life with long-term care are very similar, but have some key and critical differences. They're more of a new age type of solution for long-term care. Asset-based is more of on a limited pay so that you can pay it up and not have to worry about it anymore. And there are many features that address the concerns of the self-insure or traditional long-term care routes, such as return of premium if you never need it. There are death benefits. There's cash value that grows throughout it. And by the way, these types of solutions are all tax-free when you need that type of care. You can go through the next slide, please, Ryan. So we'll take a second now to go through each of these and kind of the advantages and disadvantages, pros and cons. Traditional long-term care, it is a lower initial cost to enter the market. However, we have seen recently and over the past 10 years that these products were essentially mispriced long ago, and we're going to see premiums increase. We've seen premiums increase. Ryan, Devin, and I have seen clients with premium increase notices. And at a time where you want to be protected, you want to know what you have, that's the last thing that you want to see is a premium increase notice. So that is one of the major disadvantages. And when you want to plan and know what you have available for long-term care, for healthcare costs, you want to make sure that it's exactly what you signed up for. Next slide, please. The asset-based long-term care policy, kind of this new age. Like I said, there are paid up periods. You pay for it typically on a 1 pay through 20 pay. A lot of people like the idea that they're not going to have to pay premiums when they might need to actually access it for care, or they just simply don't want that cash outflow going towards an insurance policy during their entire retirement years. And then there's some concerns about having long-term care. You know, if I never need long-term care, did I make a bad investment by buying this type of a policy? These types of policies actually have return or premium refund options that you can add on to address that concern. Also, if you use the entire pool of money for long-term care, there are still features that provide a death benefit to your beneficiaries if you've used the entire pool of money or if you haven't used the entire pool of money. The great advantage to these types of products is you're going to have access to your money and the insurance company's money in one way or another, and the money that you receive is going to be tax-free. And the disadvantages are it might be a little bit of a higher cost to enter as opposed to looking at a traditional long-term care policy. And there are limited carriers. So next slide, please. That leads us with the last one, which is life insurance with a long-term care rider. It's a life insurance policy, and what these insurance companies have done is allowed us to add a feature that allows the client to access their death benefit in a tax-free manner for long-term care planning. Ryan, you can go to the next slide. The advantages are you can access cash value if there is cash value. You can access the death benefit for the long-term care feature. There's a lot of flexibility when you think about how to fund this type of policy and how much you can buy for the type of funding that you've done. You can define the actual benefit for long-term care, or you can define the actual premium or investment that you want to put into this type of a solution. The disadvantages are it's kind of limited policy and rider options. There's kind of two different types of rider options out there. You do have to qualify for this type of policy and for all of these policies through an underwriting process. Some are more stringent than others. There is no ability to increase and equate for inflation in a life insurance long-term care rider. And if you do utilize this type of policy for long-term care, obviously it will deplete the death benefit associated with your life insurance policy. You can go to the next slide. So we talked about the products and the different types of solutions that are out there. There are some other things to take into consideration, which is kind of cool in the long-term care world, which is tax consequences of long-term care. There's ways to actually get deductions. So life insurance premiums are generally not deductible for individuals. However, insurance premiums paid by employer are deductible for the company and treated as compensation and income for employees. You can go to the next slide. On long-term care policies, there is actually a deductibility for the premium on traditional, asset-based, and life with a long-term care rider. And most of them are limited to these age-based limits. And so you can actually receive a deduction up to that age-based limit with some other calculations thrown in there as well for purchasing a long-term care policy. So there's some tax planning that can be had with purchasing a long-term care policy or putting and implementing in a long-term care plan. Ryan, you can go to the next slide. Ryan, I'm going to hand it off to you now to talk about real life scenarios. I appreciate everybody who's been on the call today and listened to me talk about the importance and the types of ways you can actually plan for long-term care. Ryan and Devin are phenomenal advisors that I've worked with for years, and we have implemented these types of plans for their clients to give them peace of mind and address their questions. And we can do educational seminars like this and go through the different types of ways that you can fund long-term care as well. Ryan, take it over.
Perfect. Well, thank you, Evan. Thank you for all that insight. I put this graphic in the presentation because I always feel like when we go through topics like this, to some degree, looking at this information can be like, drinking through a fire hose. And so this is probably a representation of what goes on in someone's brain after they go through this presentation. What I will say is that we like to talk about real world examples. We like to really, I think, bring home the point that regardless of whatever your circumstances are and what I'm going to go into next, that having some form of plan is valuable, whether that's insurance based, whether that's just allocating a portion of your financial resources, having an idea and having that mapped out is going to be paramount. We've had plenty of scenarios. We have plenty of stories we can share going through this with clients, but most importantly, we have tons of opportunity right now to do this planning. And with it being Long-Term Care Awareness Month, we feel like this is an important topic to bring to light. So, the biggest question that we ask clients when we're meeting and talking about any planning initiative is, what's important to you? Is it important to have a care plan in place? For some, maybe. For some, maybe not. What do you want your legacy to be financially? It's always an important question to ask. And the reality of financial planning is that we can't give a level of certainty that's always 100%, right? There's always room for volatility, variability. And so when we're planning, really what we have to look at is what's most important to you and what are the things that we can most effectively address without knocking you off your roadmap to whatever your idea of financial freedom is. So we're actually going to use a real life example. We've renamed everyone for their own protection, but Bob and Linda in this scenario are a couple clients that we've worked with that Right now, they have a portfolio value of just over $2 million. And so when we were meeting with Bob and Linda, we were going through all of this. And so this snapshot is from planning software we use. And this actually shows, based on what they told us they need for retirement income, based on where they're at today, how they're going to continue to save until they get to retirement. And as you can see, their assets last till age 88. So where we started with Bob and Linda was, let's assume everything is constant and add really no wrinkles to the plan whatsoever. Where does that get you? So at a high level, when we look at a chart like this, obviously age 88, we all hope that we live that long. In the case of Bob and Linda, if they exceed that age, we have some other planning to do outside of long-term care. But for the sake of this conversation, it was important to them to make sure that some of those considerations, things like their children don't have to become their caregivers, that they're not going to be a financial burden. And so when we're talking about the long-term care conversation, what we do and what you see in the left side of that graphic is we can go through a scenario using real life numbers and say, what happens if Bob needs care? What happens if Linda needs care? What happens if you have the unfortunate circumstance that both of you need care? And then ultimately, what's the cost of protecting against this, whether it's self-insuring, whether it's buying some kind of financial product? And then the last piece, I'll get into the growth rate assumptions, but the argument can always be made that when we transfer risk from our balance sheet to an insurance company's, and that's true for life insurance, disability, vehicle, homeowners, when we take it off of our plate and put it on the insurance company's balance sheet, that ultimately makes us more financially bulletproof. And so the end result of that is maybe we can afford to take an additional percent of risk to try to get an additional percent of rate of return. It's very small in the grand scheme of things, but that 1% over time adds up. And we'll talk about the numbers and the dollars and cents behind that. But in this example, we really just go through the different scenarios. So let's say Bob needs care. Bob's a little bit older. We use the averages. And so when we do all of these projections, we use a lot of the numbers we talked about in the beginning of the presentation: average cost of care, where you're at, where you're located in the country, statistically, how long once you go on care will you need it? And so baking all of those variables into the system, what we see here is that Bob and Linda, just by Bob going on care or needing care for a few years, costs them 6 years of potential funding and a portfolio value lost of $1.35 million. So it's important to note that that's not necessarily the cost of Bob's care, but that's the lost opportunity cost of now by self-insuring and pulling that money out of our investment portfolio. Those dollars can no longer earn interest. They can no longer grow. Once they're spent and sent to the care facility or the the home nurse or whatever type of care plan you have, once that's done, it's gone. There are other funding mechanisms, like we talked about, things like reverse mortgages as an example of another client case that we worked on with Evan. In that case, we bake those types of scenarios in here, but in the interest of keeping it high level today, I think this is just an important illustration of what happens if Bob needs care. Ultimately, what happens if Linda needs care? So the fortunate thing for Linda being younger is that if Bob only lives to his life expectancy, which would be about 84 for males in the United States today, Bob did have some other life insurance in place that death benefit would kick in. So the value lost for Linda would actually only be $695,000. I guess you could call that fortunate, but ultimately what ends up happening is there's still no legacy left over for children, for their kids, their next generation. Bob and Linda also are new grandparents. And so that was something that was important to them as well. So in both scenarios, if one or the other has to have some form of care for a few years, the legacy that they leave behind from a financial perspective is really none. And even more important to point out here, for Linda, with a female life expectancy in the United States being 87, that doesn't really bode well for her being able to actually pay for her own living expenses. You can see their assets only last till age 84. So the overarching theme here is there's a lot of planning to do. regardless of long-term care, there's other planning, but in the scope of long-term care, if either of these events occur for them, it completely throws their plan off the rails. If you're really unfortunate and you are a statistical anomaly and you both need to go on care, in this case for Bob and Linda, same rules apply. Lots of funding lost. Both of them are not going to make it. Their assets are not going to last even through their life expectancy. Retirement is going to be not a very good experience for them, and most likely not a good experience for their kids or anyone else who could be responsible for taking care of them. Another important point in the state of Maryland, which is true in other states around the country, is there are such things called Filial Laws, which basically says that you are required for people that would be considered dependents, immediate family, so parents in this case, parents, children, a couple degrees of separation there. But ultimately what it boils down to is if they need basic living expenses covered, a roof over their head, food, clothing, all of those things could be deemed a responsibility of your children. So for example, you need care, they can possibly qualify for Medicaid. There's some extra money that's needed to cover, basic living expenses. A court could rule that in theory, your children are responsible for covering for those, even if they don't want to. Those are, very specific circumstances, but it's something to keep in mind. Even, we go back to those statistics of children saying they don't want to become their parents' caregiver. But I would say that in most scenarios and in scenarios that we've actually lived through with clients, we see family members step up, but to what degree? I can tell you that it's probably not going to be to the $1 million degree in most circumstances. And so the natural question is, okay, well, let's put a plan together, whether that's using other assets or whether that's buying a policy or using an insurance vehicle to insure this. What happens if I do all this and I end up not needing care? So in this scenario, we actually use numbers that Evan and the folks at Chesapeake provided us for an asset-based long-term care policy. Why? In the case of Bob and Linda, and I think in the case of most clients, they look at long-term care as the standalone policy from a pure cost perspective. That's pretty much is giving your money to the insurance company, and you would have to go on claim in order to recoup that. So to bake in some recapture of costs. So for example, if you end up not using it, those policies will have a death benefit. They also have cash values associated with them. So if you decide you don't want it anymore, getting your money back. All that being said, when we plug in those numbers, these policies are designed to cover the estimated cost of care that we've put into our scenario. So in Bob and Linda's case, you'll see kind of partway through these blue bars turn gray, and that's really just the cost of the premiums coming out of their financial life. So they are going to lose that financial resource because those premiums are now being paid to the insurance company. But interestingly enough, what ends up happening later in life is if they don't use it, they have this recapture of those costs through the form of a death benefit. Now, the end result of the legacy for both of them, if they both don't need care, is that they have a value gained of $58,000. And really what that is that's just additional money from the death benefit being reinfused into their financial life. And that's after obviously both of their passing. So in this scenario, no other planning initiatives being considered, just talking about long-term care, by just plugging this hole in the boat, so to speak, we can create some additional value for them. Along the way, you're going to see their net portfolio values not going to look as great, but ultimately long-term care is covered. There's always going to be other planning considerations. Obviously, we don't want to view the world in a vacuum, but in this particular scenario, it works out for them. The other piece of that is, what if I insure and I do need to go on claim? So this slide's going to look a little counterintuitive, but ultimately going back to my original point, I want to bring in this default growth rate assumptions again. A couple of levers that you can pull in retirement when you have a shortfall. I don't have enough money to even live the life the way that I wanted to. There are a couple different things that you can do. You can delay retirement. You can take more risk. excuse me, and potentially get some more upside potential. And there's all these different things that you can do. You can reduce your expectations on goals. And so when we're pulling all these levers to find out what's going to give us the highest probability of success, ultimately what can lead us to increasing things like our growth rate assumptions or taking more risk in our investment portfolio is knowing that volatility will not set us off a path of success in a scenario like long-term care. So in Bob and Linda's case, if we do take that additional risk, we're not as concerned with volatility, as much volatility in the portfolio, because ultimately they have a big expense, in some cases, $10,000 a month covered. So in that scenario, we assume that we'll get an extra percent of rate of return. I don't think that's an unreasonable ask. It's a very incremental change when we talk about the plan in general. But that incremental change, what it does is it covers the cost of the premiums through additional performance, and then ultimately gives them a greater legacy. Their legacy is still not, in this particular case, with talking with them, the real world client, it's not what they want it to be. But from a cost perspective and making sure that we're addressing all the other planning needs, it's better than being negative 1.2 million or $1.3 million. So it's ultimately a solution to their problem. How you navigate this, and for any client, is going to be a little bit different. Bob and Linda, to be quite honest, are fortunate they have the financial resources that they do. If they hadn't had that, this plan would look significantly different. So when we talk to individual clients and we're plugging in numbers, every circumstance is a little different. Some are going to like certain types of solutions better than others. One, because of barrier to entry on cost, for example. Others, because they have more diverse resources to draw from. So things like being able to use a reverse mortgage in retirement. For those that don't have their mortgage paid off, it is an option, but it's not as attractive. So in this particular case, Bob and Linda, we can solve that problem. It doesn't necessarily solve all of their problems, but at the end of the day, when we focus on the long-term care initiative and some of the things that were important to them, this particular solution actually works out. Not always the case, but at the end of the day, when we talk about insurances and talk about transfer of risk, you're always going to get more leverage transferring risk from your own balance sheet to an insurance company's. That's true in all the different types of insurances that we've discussed that you're probably familiar with. It's a lot easier to have it happen on the insurance company's dime than your own. And it almost always increases your probability of success. So with all that being said, I go back to my original question. What is important to you? What we showed is a success story. Not all stories look like that, but at the end of the day, financial planning is picking and prioritizing what's most important to you and building strategies around that. If we can create a perfect world, we would love that. But in the sense of long-term care, at the end of the day, insurance product, financial strategies aside, it's really about some of the things that Evan mentioned. Putting together a plan, helping family understand who makes decisions, how they get made, when they get made, and then how are you going to pay for some of those things, and mapping that out, spending the time and sitting down and even writing that out. Some of that can occur in your estate planning process. So having things like medical directives, healthcare proxies, financial power of attorneys, having that in order is another piece of this process that we really didn't talk much about. But there are multiple tools and multiple levers we can pull to make sure that whatever your wishes are, that happens. So with that wraps up our presentation, our piece of the presentation today. In this presentation, which we'll send out to everyone, there's a glossary of terms, there's more educational materials involved. There is a recording for those that joined a little late. So if you want to jump back on in the beginning and review that, or from the beginning and review the presentation from the start, that will be available to you. But for now, we'll open it up to questions. Feel free to drop questions into the chat box if you have something specific that you'd like to address, or if you have specific questions for myself or Evan. All right, we have a question about tax deductibility features of LTC. Evan, I'll let you take that one, and I'll just go back to that slide.
Perfect.
So we have that for review.
So it depends on the type of long-term care solution you implement. And since we talked a lot about product today, that's what I will do. So depending on the type of policy, it's going to be a little bit different. With traditional long-term care, you have a calculation that you have to follow as an individual to experience tax deductibility of the premium for funding long-term care. So the first part of that puzzle is this age-based chart that you look at. So depending on your age, if you purchase long-term care, the first piece of the puzzle is the annual deduction limit, which you see on the right side of that chart. The second piece is if your long-term care premium is less expensive than the age-based limit, you take the long-term care premium, or I guess I should say, the lesser of the age-based annual deduction limit and your premium. So we'll take an example here, 4520 for somebody over 60 to 70. If that is lesser than your annual long-term care premium, you take the 4520 and you add all your other medical expenses. And if all of those medical expenses plus this age-based limit are more than 10% of your AGI threshold, then you can deduct what is over the 10% of your AGI on an annual basis as an itemized deduction. That's what happens in a traditional long-term care scenario for tax deductibility. With life insurance with an LTC rider, it is similar, and in asset-based, it is similar. However, you can only use, they break down those premiums from life insurance and long-term care, so you would just have to take the long-term care portion of that premium to figure out what that calculation is. In a business setting, if you use it as some sort of bonus plan, or you're an owner of a certain type of corporation, you can receive a full deduction of the full premium on an annual basis. So that's it in a nutshell. There are ways to calculate how to get a tax deduction for funding this type of plan.
Okay. And that's how I feel right now. Yeah, these are definitely, I would say, complex when we talk about products specifically, I would say that it's a complex scenario. Every product is going to be different. Every scenario is going to be different. Ultimately, it's about evaluating what you would like to have happen from a care perspective. So where do you want care? There's a couple different features of policies to be mindful of. One is reimbursement, meaning that you incur the expense and then the insurance company pays you back. The other is indemnity, which means that the insurance company will pay you up to your stated benefit, in advance of you potentially incurring that expense. They're still going to want to see what it is potentially, but ultimately you have a lot more flexibility to request how much money you would want from that benefit. There are different costs to each. And so ultimately, again, back to the original idea of planning. What do you want to have happen? What's important to you? How do we want to financially prepare for that? And then finding the right solution, whether it's, in some cases, there are some people that can self-fund. It's not common. I'll be honest with you. I've yet to see someone successfully do it yet. But there are solutions that you can find that can maybe not cover the total cost of it, but at least alleviate some of that cash flow burden as you go through a long-term care scenario. So if there aren't any other questions, I'll just leave it up here for a minute to see if anyone wants to chime in with any additional questions. But if you don't have any additional questions, we will stop the recording, hop off here. Feel free at any point in time to reach out to us individually. I went through this scenario of a real life client situation. These are things that we can do for an individual. These are, projections that we run for pretty much all of our planning clients. But if it's something that you're interested in, specific around the long-term care conversation or really any other financial planning conversation, let us know. We're happy to help work through that. Um, these are are completely customizable in the sense that we can add and subtract numbers, use real world resources for the person that's sitting across the table or on the other side of the screen to us. Don't feel like just because in this scenario, this person was able to do it, and one of the objections we get sometimes is, well, I don't have that much money. That's fine. There's plans for all different shapes and sizes, and we've dealt with these scenarios with clients that have significantly more and significantly less. So if you have a question that's specific that you prefer to ask offline, feel free to reach out to us. With that being said, Evan, I want to thank you again for spending time with us today, taking time out of your day to work through this with us. And thank
you guys.
Everyone else that dialed in today. And again, this session will be recorded. You'll get a link after if you want to review it again, and we'll also share the slides and any other educational materials that'll be relevant. But with that being said, I will stop recording, and thank you to everyone for attending today.